Now that we know a little bit about systematic risk versus unsystematic risk, let's talk about it specifically with regard to stocks. Stocks have both systematic risk and unsystematic risk. Systematic risk in stocks is the event where a broad-based market move is either up or down, a rally or a decline, a mania or a panic. So when you think of risks in stocks that you can't diversify, it's overall market risk. There are times when the market moves up and there are times when the market moves down in whole. It's not individual companies, it's the market, it's the tide rising and falling. There's another concept in systematic risk in stocks that is slightly more complicated. So let me see if I can explain this. It's interest rate risk. Interest rates are crucial to firms because the amount of money that they can borrow depends, or the amount of money that they do borrow depends a lot on how much they get charged for that borrowing. So let's look at it in extremes to show the example. If the company had to borrow money at 20%, they would invest in very few projects because the projects would have to return a profit after paying back the loan at 20%. Whereas if the company could borrow at 2% or 5%, to be more realistic, then the company could find products or new ventures that would only have to pay more than the 5% in profits to be able to pay back the borrowing. So if interest rates are very high, companies tend to invest less. They do less research and development. They do less growth. If interest rates are very low, all companies tend to invest more. They do more growth. They do more R&D, and so on. So when interest rates are high, that's good for, or that's bad for companies, and when interest rates are low, it's good for companies. Well, this is systematic risk. This is the risk that you can't control. All interest rates are going to be broadly set across the markets, and so when the interest rates are low, then company profits should be up, and when interest rates are high, company profits should fall. So when you think of stock risk, interest rate risk and market risk aren't diversifiable. You can't avoid them. They impact all companies. However, there are unsystematic risks that individual companies face that are important to analyze when deciding on investing in a stock. For example, business risk. Business risk is the risk of either your company making business mistakes or having a competitor come in and putting you out of business. In other words, business risk is the risk you take for being in a competitive marketplace. If you think of an example of, say, a software company could be doing very well. It could be going along with no problems. And then several things could happen. One is a competitor could invent software that replaces yours, and therefore yours becomes obsolete. Or the company could make a software product with a glitch in it or a bug that creates a problem for the users. So business risk is firm risk. It's individual to that company. Of course, a software bug or a competitor coming up with a better product doesn't impact the overall market. It just impacts that one firm. So that's unsystematic risk. It's the risk you take in owning that firm that they will make good business decisions. And if they do, of course, they profit. And of course, they make bad decisions. They will have reduced profits. In addition to that, this is much like market risk. Interest rate risk is financial risk. Financial risk for unsystematic or for the firm, financial risk is that they can't repay their loans, that they've borrowed so much money that the loan payments are due and then they can't repay the loans. So in financial terms for a company is they need to maintain cash flow, they need to be able to pay back their bonds, they need to pay their bills. These kinds of things are crucial to a firm's existence, and it is a risk that for that firm that their cash flow will not be allowed to cover their bills, their expenses, and so on. So there's business risk. A competitor could put you out of business, or you could make a mistake. There's also financial risk in that the cash flow that was projected doesn't actually occur, and therefore you can't pay back your bonds or pay back your bills. On the other hand of the financial risk, of course, if cash flow is high, then the firm is profiting and profits are up. So there's business risk and there's financial risk for the firm, or for unsystematic risk. And there's market risk, the overall stock market moving up and down, and interest rate risks of moving up and down. The difference between systematic risk and unsystematic risk in stocks is the difference of diversifying or not being able to diversify the systematic risk, the market rate risk, and the interest rate risk, and being able to diversify the business risk or the financial risks by simply buying a little bit into multiple boats on the ocean, so you don't have too much money into one particular firm. So if they do encounter a business risk or a financial risk that goes negative on them, that you only lose one of your boats, not all of your boats in the ocean. So systematic risk in stocks is market risk and interest rate risk. Unsystematic risk or individual company risk, firm risk, is business risks, whether they make mistakes or competitors force them into bad positions, or financial risks, which is not being able to have enough money to pay their bills and borrowing too much and so on. So there's business risk and financial risk for the firms. If those go wrong, you can diversify those away by owning multiple companies. You cannot diversify away the systematic risk of the market moving up and down or interest rates moving up and down. So when you think of stocks, think of the different types of risks and diversify away the unsystematic risks, and realize that there are still systematic risks no matter what you do.